Agentpreneurs, and welcome to episode 17 of the Daily List Report. Really excited about today. But first, if you're just joining us, if you're new to this show, I'm going to pull up on the screen here. We've got a new YouTube channel. Just go to YouTube, search for the Daily List Report, and you're going to see tons of really great content. So we've got every full episode of the show that we've done. We're in week 4, episode 17. We've also got some highlight clips if you've only got a minute or two to spend looking at the information and the content, but great topical, timely content there. So go there, have a look, subscribe, and be sure to tune in every day, Monday through Friday at 11 a.m. right here on the Agentpreneurs of ListReports page. I don't know about all of you, but we've got nice weather here in Southern California. Super excited about today. We've got an amazing guest. We've got Rick Sharga on. He's one of the nation's foremost experts on real estate and mortgage, and he's going to weigh in on all sorts of things. But before we get to that, I'm going to talk about what's coming up this week. So tomorrow, we've got a great session talking about how to use our product, the lead section of it, and how to get the most out of how to manage your leads, how to get your sphere into our product, make sure that they're on the right drips and that you're staying front of mind with them. On Thursday, we've got a top agent, Michael Burdellis. He's done 1,400 transactions in his career, and he's got a lot of great advice on how to build pipeline during this time. And then on Friday, we've got a nutritionist on. It's not easy to say, Risa Grau, and she's going to talk about how to boost your immune system. That is our second Fun Friday, so that's pretty exciting. So as always, we're going to go to the headlines. And as always, since we started this show, there are a lot of headlines. So I'm going to go through sort of the news that we're tracking today. And then when Rick comes on, we're going to talk a bit about a lot of these actually, because it's very, very timely. So the first one is that the National Association of Realtors reported today that existing home sales slumped 8.5% in March. Now, to give that perspective, that's still up almost 1% from a year ago. But keep in mind that a lot of these deals were struck in the January-February timeframe. And so we would expect this number probably most likely to fall even further. We're seeing some regional differences here. So in the West, western part of the United States, sales were down 13.6%. And so, as has been the case, this pandemic is affecting the country differently in different locations. We've already seen, as we started to report, listings pick up in some of the earlier affected areas. Washington is one example of that. The second headline that we're tracking today is that the share of mortgage loans in forbearance has risen to 5.95%, according to the Mortgage Bankers Association. And Rick is going to weigh in on this in just a little bit. But we saw a slightly slower uptick. We would expect this number probably to increase even further as we come into the May payment timeframe. But some news, and I'm actually going to read a quote here from the Mortgage Bankers Association. There were some news today from the Federal Housing Finance Agency that limits the amount, that increases their liquidity. And so let me just read this quote. Actually, this quote is from the CEO, Robert Brooksmith. And he says, the MBA welcomes today's announcement from the FHFA that caps mortgage servicers advancing obligations at 4 months for Fannie Mae single-family loans, effectively mirroring Freddie Mac's requirements. This is an important step in reducing the maximum liquidity demands for servicers who are providing mortgage payment forbearance for borrowers who have a pandemic-related hardship. We appreciate the FHFA's action. Last week, we had Eric Mitchell on from Gold Star Mortgage, and there was a lot of uncertainty around what was going to happen here. And so this is the first step there. Now, he did go on to say that while this news reduces servicers' worst-case cash flow demands for considerably, right, because at least now there's a finite point, it's 4 months, not this open-ended thing, we continue to stress the need for a Treasury and the Federal Reserve to create liquidity facility for those servicers who need it in order to continue making payments to investors, municipalities, insurers, et cetera, et cetera, et cetera. And so there's some downstream effects of that. Now, we're also seeing a tightening of the mortgage market. So JP Morgan, US Bank, Wells Fargo continue to tighten their requirements for loans. So we talked about last week that JP Morgan Chase suspended home equity lines of credit. It was interesting as I think back to the '08 crisis when anecdotally people were using their houses as credit cards and buying cars and boats and all sorts of ridiculous things. And so maybe there were some lessons that were learned from that. But we're seeing JP Morgan now is requiring a credit score of at least 700. And again, this doesn't affect some of their really low income borrowing programs. It must put down 20% of the total purchase price. So they're clearly seeing some uncertainty in this. US Bank has increased its minimum credit score requirements to 680. And as we talked about last week, Wells Fargo, basically for a jumbo loan program, is only allowing customers that have at least $250,000 in liquid assets to be able to refinance and get a jumbo loan. So all sorts of things happening. Now, on the brighter side, it looks like we're closer to getting approval on some additional funds into certain aspects of the CARES Act. So Senate Democratic leader Chuck Schumer said this morning that they're really close to an agreement on a $500 billion aid package. This would be an additional package. About $300 billion of that is going to go to boost the PPP, so the Payment Protection Program that we've talked about at length actually on this show. And as you know, that money ran out last week. They're not taking any more applications. And so there's been some jostling back and forth between Democrats and Republicans about providing additional funding to that and what additional funding would come on top of that in the form of benefits to hospitals specifically and some local government. So it looks like it's close. So again, if you haven't gotten your application ready, you must do that. There's some challenges right now, right, in terms of how this money is being allocated. There are certainly some businesses who probably shouldn't have gotten it that have gotten this money. But I think the average loan size, if I look at this, the average loan size was $206,000. And so they're trying to get as much money as they can to smaller businesses. So lots and lots and lots of news there. So what I'm going to do now is I'm actually going to introduce our guest for today. Really excited to have Rick on. I've never actually read a bio before, but this guy deserves reading of a bit of a bio. So I'm going to totally embarrass Rick here before I bring him on, but we're going to go through some of his things. So Rick, I've known Rick now for 4 or 5 years when he was at Ten-X as the chief marketing officer, and he's just always been super gracious with his time and super knowledgeable. So Rick is currently the president and CEO of the C.J. Patrick Company. He's one of the country's most frequently quoted sources on real estate, mortgage, foreclosure trends. He's been a regular on CNBC, the CBS Evening News, NBC Nightly News. We're super lucky to have him. He was, again, previously the chief marketing officer of Ten-X. Before that, most recently the an EVP at Carrington Mortgage. He's a member of the corporate board of governors of the National Association of Hispanic Real Estate Professionals, Advisory Council of the Asian Real Estate Association of America, and the Board of Technology of Southern California. All sorts of great things. So what I want you all to do is I want you all to welcome Rick Sharga. Hey, Rick, how you doing?
I'm doing very well. Thank you for having me today.
Now, it's a pleasure to have you. Say a quick hello to our agentpreneurs.
I love the term agentpreneurs, and it's a very appropriate term for people that are always reinventing themselves and trying to make ends meet and move the business forward.
Absolutely, absolutely. I wore a shirt last week that was from one of our investors, and it said "Be a founder," and it just felt really appropriate to this time, right? I mean, as an agent, as either a sole proprietor or a team or a broker, right? You are constantly having to reinvent yourself and dig really deep, especially during these times.
Well, these times give all of us a chance for reflection and a chance to really work on ourselves and on our businesses that we don't often get in the hectic day-to-day environment that we all want to get back to.
Yeah, you're right. Exactly. Exactly. So, Rick, why don't we do this? We've got a couple topics we're going to cover today, but what I'd like you to do, if you don't mind, is I covered a bunch of headlines there. And so the announcement from the FHFA, can you just talk to our agents a little bit about what that means and what that means in particular for the agents who are on the other side of making sure that their buyers are getting mortgages?
Yeah, the FHFA announcement is huge for the industry, and I guess the short answer is it means there will be loans available for people who want to buy houses. I don't say that cavalierly, but there was a very real risk of the servicing part of the mortgage industry going bankrupt if there weren't some credit facility available or if there weren't a cap to what they'd have to spend. What a lot of consumers don't realize is that even though they may not be making their mortgage payments, the mortgage servicer is required to continue making payments to the investor that owns those mortgage loans. And my back of the envelope math said that if 25% of borrowers took on that forbearance program and didn't make payments for 6 months, it would have cost about $90 billion, which would have effectively bankrupted that part of the system. And people don't realize the interdependencies between the servicing arm and the origination business and the secondary market and the investors that buy the loans. You said something just sort of in passing about downstream implications. and servicers are responsible for paying property taxes. If those servicers suddenly go bankrupt and aren't available to pay those taxes, municipalities might have to start restricting services or raise taxes. So there's all sorts of things that go on with that. But the fact that there is now a finite limit, the fact that both Ginnie Mae, which had put in a credit facility previously for emergency spending, and now Fannie and Freddie are covered as well, really should bring some more stability, which we really need at a time like this
Absolutely.
into the lending business.
Absolutely. I mean, put simply, right? Whenever we borrow money, those people borrow that money from somebody else, and so there are
Yep.
obligations that continue all the way down the stream. And to your point, which is interesting, even to local governments and municipalities in the form of property taxes, and that affects local services. So everything is intertwined and connected here.
Yeah, to be clear, this
Please.
is not a bank bailout, which
Hmm.
seems to be a fairly popular social media meme.
Yes.
Uh, this is really the responsible thing to do once the government has put in place programs that allow consumers not to make their mortgage payments for very good reasons. And
Yes.
I think that the important thing, and maybe a lesson learned from the last recession, is that it's much better to get out in front of these problems and prevent people from going into default. That's a lot easier to resolve than once somebody has officially defaulted on a loan and trying to fix it. So I
Yeah.
do think the intent was right here. It's a program that was executed very quickly without a lot of attention to detail. But I think we're kind of seeing the process work the way it should right now.
Yeah, and I think that's an interesting point because this happened so quickly. There's no scenario where it was going to be executed perfectly, right? So
No.
when I see that $300 million of the $350 billion in the PPP went to companies that were publicly traded, that's unfortunate. Did they need that money? Probably they didn't, right? But 300 million out of 350 billion, things are going to slip through the cracks, right? These things are going to happen.
Well, and similarly, I'm sure there are people signing up for forbearance programs that really don't need forbearance programs,
That's the other
but
point. Yes.
have decided they don't really want to pay their mortgage if they don't have to for a while.
Yeah.
And I get that. I would have loved to have seen some teeth built into the program so
Mm-hmm.
that people that did game the system paid penalties. And for all we know, there might still be something down the road that happens along those lines.
That's
It is
interesting.
it is sort of like fraud, so you have to be careful about things like that.
Yeah, yeah. With Saul, our chief operating officer and the former president of retail lending at Veterans United, she was on a week or so ago, and we talked about this in the context of like a moral hazard, right?
Yep.
And the message was, look, if you can keep paying, you need to keep paying, right?
Yeah.
This isn't a free for all. If you're in a position to pay, pay your mortgage because of all those downstream effects. And you're right. There's really no checks or no teeth, as you said, in these programs. So it's interesting when you suggest that it's possible that retroactively maybe some of those teeth could be put into place.
Well, at some point, the lenders are going to be, or the servicers will be working with the borrowers on repayment programs. And by the way, for any of
Mm-hmm.
your agentpreneurs who get the question from borrowers, those repayment programs have three different options. One is that the deferred amount can get tacked onto the end of the loan, which is probably the best for most borrowers. Excuse me. A second is they can be built into the balance, and the loan can be reamortized or modified, which would raise the monthly payments a little bit, but probably not much, depending on the length of the loan. And then the third is there's a balloon payment option, which for most people is a really bad option. It basically means that whatever you've deferred is all due at the same time as soon as the deferment period is over. If somebody's been out of work for a few months, the likelihood of them having 3 or 4 months of extra cash to make a mortgage payment is pretty slim. But when those repayment options start getting talked about, I think the lenders are probably going to look for some proof that your finances were hampered because of COVID-19. And I wouldn't want to be the borrower to have to go back to the lender at that point and say, "Hey, just kidding. I've been collecting a salary the whole time."
Right. Exactly. Exactly. Um, so, so Rick, let's shift into one of the topics that we talked about yesterday, which is
Mhm.
may seem a strange place to start in the context of residential real estate. But what we talked about, and I would love for you to share your thoughts on, is the commercial side. We've been talking a lot on this show about kind of fundamental, deep-rooted changes that are going to last well beyond this, and commercial is an interesting aspect of that. AJ and I touched on it last Monday on the show. So I'd love for the audience to hear your perspective on what you see happening in the commercial space.
Well, I think there are some clear winners and losers in the commercial space coming out of the pandemic. A clear winner is going to be the industrial space, and I think that's going to be in three parts. I believe we've seen an acceleration in e-commerce, which was sort of a necessary evil this time
Yes.
around. Didn't have much choice, but that has shown some weak spots in the national warehousing and distribution model, where Amazon is trying to ultimately get to almost instantaneous delivery for all of its customers. So I think you'll see an uptick in warehousing and distribution. Similarly, I think you're going to see more server farms as people do more distributed computing, more work online, and so you'll see more computer centers being built. I also think you'll see some flex manufacturing capabilities become sort of a government mandate. We've discovered that in times like this, it's really been difficult to reorient manufacturing to create things like ventilators and masks. And we also are made painfully aware of our vulnerability in having pharmaceutical manufacturing being done predominantly offshore. Almost all of our generic pharmaceutical or antibiotics are being made offshore. So I think industrial is a clear winner. I think in the short term, the hotel space is going to be devastated. Most hotels are running at about 10% occupancy rates right now. And I think a lot of the smaller owners will probably be hard pressed to survive until the market turns back. I think retail is going to be in for a challenge. It already was struggling a little bit, but with a number of retailers who were sort of teetering on the edge of bankruptcy, now going months without any revenue, I'm not sure how many of those survive to the end of the pandemic, which will put more pressure on retail space. So those are kind of the obvious ones. The two that are interesting to me, most interesting really, are multifamily and office. On the multifamily side, I think there's going to be some short-term disruption because I believe personally that renters are being more impacted in the early stages of this economic downturn than homeowners are.
Hmm.
If you look at the industries most affected, travel, tourism, hospitality, retail, restaurants, the majority of jobs are relatively low paying hourly jobs. Those workers tend to be much more likely to rent than to own. And so I think short term, while there are moratoria in place on evictions by landlords, and where millions of Americans are unemployed and maybe unable to pay their rent, you may have some financial pain in the short term. On the other hand, I think a lot of people that might have been getting ready to become homeowners for the first time may have to rethink that and get their finances back in order, especially in a credit tightened market, which you talked about earlier.
Yes.
So there will be more demand for rental properties after we get through this short term churn. And then finally, there's office, and office is probably the most fascinating of the industrial or the commercial segments. I think a lot of companies are going to look up and say, you know what, this wasn't such a bad thing having everybody work from home.
Yeah.
Maybe we shouldn't be paying a massive amount of our income into infrastructure and overhead. Maybe we can get by with fewer people working in a central office, and we could even have more of a distributed office arrangement rather than having one massive complex in an expensive geography. Maybe having smaller offices located in less expensive markets around the country. Um, even the infrastructure inside offices may change as
Hmm.
we found how difficult it is to do any sort of social distancing in most office environments. So I think long term, the office sector might undergo some of the most significant and profound changes of any of these sectors.
I think you're right, and we've observed that, as a company, right? We're a technology company, generally very forward looking and open to new ideas, and yet we never had a culture of working remote. We had a culture of everybody coming into the office, and this has completely changed our view on that. I shared a story with you yesterday. One of the people who works for me on my team, his wife has said for years, "Hey, why don't we move to Timbuktu?" Right? And he's like, "I absolutely cannot move to Timbuktu. I have to be here. I have to have FaceTime." And he's 180 now, right? He looks at it and he's like, "I
Yep.
can absolutely do my job from Timbuktu," right? And so, and from a company's perspective, it opens up our ability to recruit people anywhere and everywhere. And there are a lot of companies that do remote, but it's certainly not the norm. And so it's fundamentally changed how we think about it. And I think what's interesting in the context of our audience in this topic is what might that mean for residential real estate? So I'd love for you to weigh in on your thoughts there.
Yeah, we were talking about this yesterday, and since I opened up my consulting practice, I've been using our fourth bedroom as an office, which used to be a guest bedroom. But
Yeah.
I wonder how many people will now start looking for that house with an office or with an extra room that can be converted into an office, and it becomes more of a work at home model. So the the grid that the utility grid that the house might be on, uh, how good are our internet services in a given market, and things along those lines might become more important factors for people to consider as they're buying. So I do think there will be some changes, and there will be some if this gets carried out to its full extreme. You look at a place like Silicon Valley, where your rush hour commute is 4 hours each way, so it's basically
Hmm.
a whole day's commute. As people have had to move farther and farther from their work locations in order to be able to afford to live somewhere in the vicinity, all that could change.
Yeah.
You might not have that kind of congestion, that kind of sort of mandated density, and it can change a whole lot about the real estate market as we go forward.
Absolutely. And, as we play this out, right, in the possible scenarios here, one of the things that I've thought about is given what we pay for the set of offices that we have for our employees, if there a way to pass on some of that, not pass on that cost, take some of that money that we're spending and actually give it as a benefit to our employees. And let's say that someone's a renter, just as an example, right? And they had an extra $500 a month. We're going to save money. They can get that extra bedroom depending on the market that they're in. And I think it's a win-win. Everybody's happy. We may have to lobby for some tax law changes to make sure that
Yep.
these things can be written off in the right ways. But all of those things are possible, right? And we've seen with our employees largely people just happier and more productive. And why should we ever go back to the way it was? And here's the point, Rick, just to make it, to sort of bring it home for our agents, is this is the world that we believe is the future for all of our agentpreneurs, which is a world of more flexibility, more efficiency, more time with your family. It's instead of driving all over town and setting up on a Sunday morning for an open house when you could be at your kid's t-ball game when they can play t-ball again.
Yep.
It's a beautiful world, I think, that we can enter into out of this crisis.
And just kind of circling back to the commercial real estate conversation, it maybe becomes a consideration for apartment building owners to build in
Mm-hmm.
some satellite offices or some shared workspaces. Maybe some of those retail
100%.
facilities that no longer have that one extra shoe store.
Yeah.
Maybe they now have some work facilities as well that people can use if they don't need to go to the office, but they don't want to be working at home all the time. So there,
Yeah.
I think coming out of this, there will be opportunities and changes that, again, agentpreneurs should be paying attention to.
Yeah, absolutely. So Rick, let's talk about. You wrote a report recently. Why don't you talk a little bit about the report? It's free and it's available. Everybody should take a look at it. But what it really did was sort of took a look at some lessons from history in the context of what's happening now. So we'd love for you to talk a little bit about what you learned and make sure we can post a link. Let's make sure everybody understands how to have access to this.
Yeah, thank you. It reports called "Pandemics in the U.S. Housing Market," and surprise, surprise, there's been a lot of questions about, excuse me, how the housing market might fare going through this pandemic. So, I was curious and took a look at prior pandemics and went back to the year 2000, taking a look at the SARS pandemic, the swine flu pandemic, and how housing actually made out in both cases. And the spoiler alert here is that the housing market actually performed better than the overall economy, and certainly performed better than the stock market through those two prior pandemics. Housing has shown an amazing resiliency coming through those sorts of global issues. And even the swine flu, which happened during the Great Recession, we didn't see the pandemic have any material impact on either home transactions or prices. I also took a look at the terrorist attacks on 9/11 because that was the last time we had the sort of economic shock that really just sort of shut down the economy temporarily.
Mm-hmm.
And while, understandably, we saw transaction volume dip a bit in September and October of that year, after that, it took off like a shot, and home prices went up, I think, 20 of the next 21 months. So the good news is that, again, if you go back through these pandemics, even if you look at prior recessions going back as far as World War II, in most cases, housing outperformed the overall economy, and in many cases, housing was actually one of the important components of dragging the economy out of the recession. The one notable exception, of course, was the last recession, the Great Recession, which housing actually took us into. So it behaved a lot differently. But while COVID-19 and um, the activities that governments have put in place are certainly unprecedented in our lifetime. Um, the fact that the housing market was very strong going into the pandemic, and the fact that historically it's performed pretty well coming through these things, gives us some hope that recovery, should be a realistic hope as the pandemic winds down.
That's great. That's great. And we can post a link, but how does everybody get access to this free report?
Actually, right now it's not posted anywhere
Okay.
online. So if you have a copy, you're
We'd be
free to
happy to
distribute to
share.
anybody who's interested. And eventually, when it is posted online, I will get you a link that you can use for future reference.
No, no problem at all. We'd be happy to share that. It's great information. So, Rick, let's sort of bring this home a little bit. We're going to talk in a moment about this really exciting webinar that you have coming up. But, as you think about an agent right now who is wrestling with a tremendous amount of uncertainty, and as we've been arguing, should be in front of their sphere every day, reassuring them, educating them, updating them. What's kind of bringing home? What's your best advice? What should agents be doing right now?
Well, the short answer is don't freak out about the numbers.
Yeah.
We are seeing unprecedented, hopefully once in a lifetime numbers that, if all you do is pay attention to the negative, you can get overwhelmed by it. Um, there, the market demand for housing far outpaced the available supply, and I think once we get through this, and jobs start to be filled again, you're going to see a return of that demand. So this is not a question of if; it's a question of when. And the challenge right now is survival. Candidly, if there are two things I'm telling people. One is, make sure you have enough cash on hand to get through.
Yeah.
But the other is, if you can afford to do it, make sure you stay as present and visible as humanly possible. I'm following my own advice. I've been more active on social media, more active doing these kind of conversations than I had been before the pandemic.
Hmm.
And I think for people who can do that, my experience in every market segment I've ever been involved in is that people that market, people that stay visible and stay active through a recession, typically gain share of market from their competition once the downturn is over. So stay connected, stay informed, stay on top of your game. Um, don't push your clients, but make sure that they know you're ready when they are to restart the engine of housing commerce.
Absolutely. Thank you for that, Rick. And Agentpreneur is right. You're hearing basically a version of the same message from everybody who's come on. Everybody who's found success in this industry is saying the same thing, which is this is a unique opportunity for you to double down and have the mindset that you're going to come out of this better than you entered it. And some of the greatest companies, not just in real estate but in technology, were actually built during
Yep.
recessions and very, very challenging times. Like you hear that story time and time and time again. Right? You're hearing it again today. Um, Rick, I definitely want to talk because you have a really exciting webinar coming up, and I'm going to pull this up on screen. But can you just give a quick intro to that, and we'll make sure that we post the link as well because that's pretty exciting.
Yeah, I'm really excited about this, actually. Thanks for the opportunity. I'm partnering up with one of the brightest minds in the industry, Mike Fratantoni, who's the chief economist of the Mortgage Bankers Association. And we are going to be talking about what's next for housing, and whether or not COVID-19 might actually derail the housing market. Spoiler alert, neither of us think it will. Um, but it's a free webinar that's going to be taking place on April 29th at 10 a.m. Pacific time. We'd encourage everybody to tune in and spread the word. We'll be talking about what's going on in the overall economy. what's happening in the mortgage market, what's likely to be happening to interest rates going forward, the latest information on home sales, and why we think the market is better positioned to survive this recession than it was during the Great Recession. So Mike is one of my favorite people in the industry and always has great insights. And I'm looking forward to partnering up with him. It's an event sponsored by DataTree by First American, and want to thank them for providing the opportunity for us to do this.
That's great. That's great. It looks like an amazing event. I'm definitely going to attend, and we'll get that link posted in the comments. So hopefully we can drive some attendees for that as well. It's funny, right? We're living in this world now where there's like live shows like we're doing, and video conferences and webinars here, and I feel like we need a better way to organize all of these things, like must-see TV. It's hard to keep track of everything, isn't it?
It's almost impossible. They're all springing up every day. The important part for people to remember is they should be watching you and me, and disregard everybody else.
Absolutely. This is the must-see TV, isn't it?
Yes, yeah.
That's tremendous. Hey, Rick, thank you so much for always being so, not just today, but just always being so gracious with us with your time and your feedback and your insights. Tremendously helpful information. So thank you so much for joining us today.
Always a pleasure.
All right. Fantastic. Well, that was tremendous. It's not often that we all get to hear from somebody who deeply understands the underpinnings of this industry and what's happening. And I'm just grateful that we had an opportunity for Rick to join and share that. And what I would encourage all of you to do is to take this video and share it out. This is information that everybody needs right now. So please help us and help your colleagues by sharing these videos. And we're excited about the rest of the week. Again, tomorrow we've got some cool product training around leads and how to nurture those leads. On Thursday, we've got a top agent coming on talking about how to build pipeline during this crazy time. And on Friday, we've got a Fun Friday. You're going to get a free lesson on how to boost your immune system. Fun Fridays have been super popular. I'm excited for that. So thank you, everybody. Thanks for joining, and we'll see you tomorrow.